Lesson 4, Business Finance. How do you know if your business is making a profit and you have enough money to continue your business? The best way to know this important information is to record and classify all your business transactions in an organized and systematic way to obtain financial statements. To achieve this, you can use a computer program for bookkeeping and the help of an accounting professional. Here's our chapter headings: computer programs, accounting software, accounting cycle, accounting methods, cash management, depreciation, accounting materials, and payroll accounting. Let's look at computer programs. A good computer program for accounting will allow you to generate invoices, record transactions, prepare financial statements, issue checks, and file your records electronically. What kind of transactions does a contractor need to follow up with? Well, purchase or lease of vehicles, purchase or rental of machinery and buildings, salaries and employee benefits, obligations to the government, purchase of office supplies, payments received from customers, purchase of materials and supplies for construction work. Incredible numbers of pieces of paper were involved as we grew. When we were doing $1 million worth of floors every year for the last 25 years, we had a lot to process. A computer program at that point, absolutely essential. You can find several computer programs that are very popular for accounting in small and medium businesses, like QuickBooks, FreshBooks, Microsoft Dynamics, among others. Do your research well before choosing what best suits your business. Bookkeeping. Your favorite thing. The first step in the accounting process is bookkeeping. The financial statements come from this information. Bookkeeping is the exact record of all financial transactions that occur in the business. Some tips for good bookkeeping include: keep your bank accounts, your check, your savings, and credit cards for your business completely separate from your personal bank accounts. Balance your bank accounts monthly. Yeah, when's the last time you did that? Save all your receipts and write down and register how you use them. Update your business records every day. Avoid paying with cash so you can track your expenditures. Keep all your financial records for the time required by the IRS. There are your tips for good bookkeeping. They want you to know a little bit, just to introduce you to the idea of the accounting cycle. I truly hope you already have an accountant in your life, because this is going to be a good accounting person is going to be one of your major partners in your business. They should be on your team, and you should develop a relationship with them over time, and they will teach you a lot about how to look at your business with numbers. The accounting cycle. The accounting cycle is a process that is repeated in each reporting period. 1, you classify and record the transactions. Now think of yourself with a whole bunch of receipts, different kinds of receipts. They've got to be classified. Is it incoming? Is it outgoing? Is it an overhead expense? Is it an expense for a job? That's your first job. 2, post those transactions. Posting means placing that transaction in the right column in your accounting system. Number 3, adjusting entries. I'll give the example of my stock entry. I purchased things for stock that were in the shop. Those things got taken by installation people out to the jobs and installed or used in installations. So stock would come in and then stock would go out. I didn't have a good system for knowing exactly what people were loading up into their trucks. But I could, with my job breakdowns, that was my job cost recording system, I could go and see what the estimator had figured would be used on that job. So at the end of the month, I would have a pocket over here that said stock and would just have everything in it. I would have to remove stock and put it to materials costs for businesses. That's called adjusting an entry. And there are other types of adjustments that can be made. Your accountant is going to be your guide. Number 4, prepare financial statements. In the QuickBooks system that we used the last 10 years we were in business, you could push a button at any time and find your financial statement for a month, for a quarter, for a half year, for a year. You could easily get a financial statement. 5, analyze those financial statements with ratios. We'll talk a little bit more about that one later. 1, classify and record. That's the first thing you're going to do. Examples of source documents include cash receipts, credit card receipts, customer invoices, purchase order material invoices, deposit slips, and time cards. Number 2, you're going to post those transactions to 5 basic types of accounts. In your bookkeeping system, there's an asset column, that's what you own. There's a liability column, that's what you owe. There's a column for equity. Equity refers to the owner's investment, your money that is in the company. Income, that's your sales, that's what people are paying you to do your work. And expense, what did you spend to make that happen? Number 3, you're going to make adjustments to the entries. Your accountant will be your guide, but you may have some prepaid expenses to adjust. You may have some accrued expense that just keeps piling up all year. You might have an inventory adjustment like the one I mentioned. You might have accrued revenue. You might have unearned revenue. All of these terms your accounting people know, and they can show you how it affects you, what you need to do with it. Number 4, prepare financial statements. We're going to get a balance sheet, an income statement, which is sometimes referred to as a profit and loss statement, and a cash flow statement will be the 3 kinds of financial statements that you will regularly want to review in your company. Number 5, you're going to analyze the financial statements using industry ratios. Picture yourself, 3 or 4 years down the road, your company is growing, you have a decent year-end financial statement, and you're sitting there looking at it, and you say, okay, what does this all mean? Well, one of the things you're going to do is take ratios that you get from the construction industry. One of those ratios could be something like, well, how much do construction companies my size spend on materials as compared to their overall sales? How much do most people spend for materials? Wow, I spend a lot more. What's going on? And then that's something for you to look at. How can you lower your expenses? When you finally get to the point where you have good financial statements and your accounting people have helped train you, or maybe your bank, I took like a 6-week course in how to read my financial statement, my profit and loss statement, my balance sheet. And then I took it again because it was not that easy to understand. So you will be learning these things for many years. There are 2 basic accounting methods. One's called cash. That's where you record your income and expenses in the year just as you receive it or pay it. It's like real-time recording. Or there's a method called the accrual method, which I believe your accountant, when you get this person, is going to suggest. This recognizes income and expenses when they occur, not necessarily the day you paid for them. That means if I've got jobs going on at my year end in December and I end up not paying for some of the materials until January, I can make adjustments. I can pull those expenses back into my December statement. Very good discussions with your accountant in terms of how this all works. The 3 types of financial statements are the balance sheet. On the balance sheet, you will see your assets. That's the things you own. Your liabilities. That's the things you owe. And your owner's equity. That's the amount of money, of your money, that is invested in the company. Number 2, an income statement or a profit and loss. This is the favorite one. You just run your finger down to the bottom and say, did I make money? And wow, I did. It is a summary of the company's income and expenses. It shows profit or loss as per a given period of time, for instance, monthly. Number 3, a cash flow statement. A cash flow statement, in a mysterious fashion, summarizes your current cash position. All of these statements are useful for a number of different ways you can look at your company. Use 3 types of financial ratios to analyze your statements. A liquidity ratio. That can tell you, can you pay your current debt? A debt ratio. The percent of funds in your company that come from creditors. A return on assets ratio. How much money are you making on your investment in your company? Financial statements not only provide you with a report card on the financial health of your business, they are also documents required by investors and lenders to determine whether or not they will invest or lend money to your business. Let's talk about billing and collections. I always like to say at Lino, the job is not finished until the statement has been sent. Billing promptly. Billing and collections, 2 important ways to maintain a positive cash flow, have the cash you need to operate, are to invoice clients promptly. My favorite invoice says 1/2 down, 1/2 on completion, and on the invoice it says due on receipt. As soon as I hand it to him, it's due. To bill promptly and use clear payment terms like due on receipt. That's what I would like on your bills, your statements, due on receipt. There's also a bunch of other things that you can practice this when you're buying something. When you're buying something, take a good look at the invoice. It could say net 10, net 30, net 60. That's 10 days to pay it, 30 days to pay it, 60 days to pay it. Could say COD, that's cash on delivery. Got to pay it to me now or you can't get the material. EOM, it means end of the month. Or it might be set up so that you get a discount if you pay early. You can make 1% if you pay it in 10 days. You pay the balance net at 30 days. You can make 1% if you pay it in 10 days, and the net is due at the end of the month. Now, you can offer these kind of terms to your customers, or you could be the customer getting these kinds of terms. Again, best one for you is due on receipt. Number 2, be systematic about collections. Send a clear and professional invoice. Follow up promptly on past due invoices. Make a collections call. Send a reminder for delinquent accounts with steps for collections outlined. Now, when you originally start your company, your projects may be small, half down, half on completion. You may be the installer. You're there. You're the person who's working on the project. So you pick up the check when you're finished, when you do the walkthrough, and then you get the check and get paid. So you don't really have to offer anybody any terms. So you shouldn't have any collections theoretically if you did every single one of your jobs like that. But what happens is you get to be a subcontractor on a great big project, and it takes 6 months to get the job done, and you're ending up doing progress billings to a very large company that has a complicated accounts payable department. When that happens and you're working with your first big company, always call the accounts payable department, find out who's going to be in charge of your invoices as they come in. After you send your invoice, call and make sure that the person got it and that they don't have any questions and there's no reason why they can't pay it on the very next round of checks. You will really speed up your collections with your large commercial contractors if you do that. Bad debts can be recorded in your accounts receivable and deducted from gross income. Just a factoid for you, your accountant will help you with this. If someone should slip through and you do not collect the balance on the completion of the job, and you send them a statement and they ignore you and they continue not to pay you, after that has aged for some months, you may be able to call it a bad debt if you feel you are just simply never going to get paid. It does happen. You don't want it to happen too often. It's really a killer for your profit margin. Depreciation is the process of devaluing a fixed asset as a result of aging, attrition, or disuse. Depreciation, a great accounting term for getting a non-cash discount from your taxes. Depreciation is a non-monetary expense that you can report on your tax return. So what type of fixed assets can you depreciate? The most common, vehicles, large pieces of a big new computer, some buildings, some machinery. Your accountant will help you set up depreciation schedules for those items. There are two methods to depreciate fixed assets. One's called straight line depreciation, often 5 years, and there's one called accelerated depreciation. So we're just going to give you an idea of what this straight line depreciation looks like. The formula to calculate straight line depreciation. I take the initial cost of the asset, say it's a $25,000 truck. I minus the salvage cost at the end of 5 years. I'm going to call it $5,000. If I take the cost of the asset minus the salvage cost, I'm going to get $20,000 worth of depreciation cost. I'm going to take that $20,000, my depreciation cost, and I'm going to divide it by the years of useful life. In this case, I'm going to say 5 years straight line depreciation. So annually, for the next 5 years, I can take $4,000 of depreciation, and it will factor into my tax liability. Use straight line depreciation for those assets that will be replaced at the end and not before of their useful life. So you're planning on keeping that truck much beyond that initial 5 years that you're depreciating it, but it is an advantage to you. Again, a good accounting partner is a necessity for you.